I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Good morning. My name is Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm T3 Live Editor-in-Chief John Darsie, here to bring you the morning call. So Scott, we've seen a lethargic, choppy tape in the S&P. There has been some movement in individual stocks, but everybody's sort of been waiting on the macroeconomic reports this week that are expected to stoke the market a little bit, stoke some volatility. Is that what you're expecting today?
Well, you know, we start our 3-day slew of economic data starting today with the GDP at 8:30 and then the Fed at 2:15. And what I think traders are watching is what's going to happen to this range. What's going to happen with the S&P? You look at the S&P here and you will see, you know, if you remember that May 22nd outside day, that's what broke this ascending channel to the downside, right? From there, 6% lower, you know, another little tradable move through the 50-day here. From there, you bounced, had some nice digestion. We took back the 50-day, and now here we are going sideways. This is now 14 sessions that we've been holding around the 8-day, above the 21-day. You know, for those looking at it technically, you could actually say it's like a nice bull type flag, right, which is a continuation pattern. But anytime you've had such an extended period run like this, sometimes, you know, you can get some kind of sneaky pullback. So I think at this point, we have our levels. You know that once we start getting above 1692, maybe you start cheating long for a move through the highs. But if we start breaking below 1680, you know, you could see something to the downside. And usually it gets sparked when you have all this kind of macro data coming out.
And a lot of people have been looking towards Japan as a potential caution sign, as a sign not to be asleep at the wheel in this market. As Japanese markets, well publicized, 20% move off the highs. Everyone's saying that's bear market territory. This run for Japan is over. They're a country that has been very dependent on monetary policy and things like that to stoke their stock market. But then recently we've seen that big move lower in the Nikkei. Is that something you're seeing as a warning sign or just something that's keeping you on your toes?
Well, I don't think anyone wants to get caught in that type of 2-session sneaky 5-6% pullback, because if you look at the chart of the EWJ, you will see that, you know, here was that outside day on May 22nd, and that led to about a 20% decline off the lows, like you said. But we were also about 50% higher from, you know, a year prior. So with that said, you know, we've even talked about playing the bounce in Japan, and you had this nice reversal here that led to a move, higher low, and then looked at this nice trending move, and everyone all of a sudden said, you know, skies are clear, looking like we're digesting above the 8-day moving average right in front of highs. And then look what happened. Boom, 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 all the way down. So that's 6% very quickly. Now, I'm not saying that's going to happen in the SPX. All I'm saying is, you know, no one wants to get caught in that, and I think it's a matter of time frame. To me, I think it's just a matter of when we see a 1700, you know, print in the S&P. It's just whether it's going to be in the next 3 days in August or sometime in the fall. And if you're extra active and extra cute, you don't want to be caught in it because, you know, you can make money from the other direction.
Besides potential range resolution in the S&P and our indices over in the United States, people are looking towards gold and bonds, obviously, as the big commodities and ETFs that react to Fed announcements. And the TBTs is the inverse bond ETF, which when the Fed comes out and is very accommodative and very dovish monetary policy, the TBT tends to go down as bonds surge, and gold tends to go up as maybe inflation expectations rise a little bit. What are you expecting from this report and obviously the reaction from those two ETFs?
Well, what's good about it is both of these sectors are very tight. Both of these ETFs give you at least levels to trade against, which is a trader, that's all you ask for. And you hit the nail right on the head. If they come out and they sound as if they're not going to be tapering quickly, okay, that they're going to be very, very accommodative and you know, maybe even making signs that they're not going to start in September, October, which I do think they will. Okay, so all of a sudden you take a look at gold, you know, gold will probably go lower. Okay, if you know, all of a sudden, you know, the economic signs aren't yielding whatever, they're going to stay the course, blah, blah, blah. chances are this tight range in gold gets resolved to the downside, which is, actually, wait, which way did I go with that? If they come out and they say they're going to taper faster, okay, that means gold goes down and rates go up.
Correct.
So taper faster, anything ahead of schedule, that whole kind of thing. Then let's do the TBT first. Okay, it's what is it today? Hump Day Wednesday. So boom. If taper talk very loudly, economy getting better, TBTs break above 76.50, and you can get a trade there. I'd watch that between 215, and 315. If they come out and they sound as if it's going to take a lot longer than they thought, then TBTs probably go down, and then you look at gold, which is very tight right here in front of another downtrend, then it goes up. So I would say watch these two inside ranges above 130-ish or 129.5. You could see some kind of spike to the upside, below 126.5, spike to the downside, and it usually trades inverse to obviously the TBTs there.
So moving on to the sector spotlight, as we talked about, there's been a lot of stock-specific action due to earnings season. There's also been pieces of just one-off news that have triggered moves in individual sectors. And obviously yesterday we saw that big news out of the potash producers as a Russian cartel, a Russian potash producer announced that they were going to sort of break up a cartel that was in place and increase their supply, their production of potash. And that triggered a huge move lower in a lot of these potash names, as a lot of media outlets were reporting that the price of potash could go down by as much as 25 to 50% because of this higher supply. And a lot of the names that we watch closely in U.S. markets, the potash names were just absolutely crushed.
But before we get into that, I just want to talk about something real quickly, because this is something that traders, do poorly. Okay, remember the day before CF, Third Point came out and said they're going to buy a stake in it, at what 2:53 o'clock, and just to talk about that, what a lot of traders do sometimes is when news comes out on a specific company, they start looking at the secondary and tertiary plays and not just going with where the news is, where the positive announcement is. So with that said, you look real quickly at CF. This was the move that CF had. Okay, CF had a really nice move. It was, in a lethargic sector. The ags have not been the place to be, but had a really nice move. Okay, and guys caught it that were prepared, in the trading floor, whatever. And if you took it home, okay, just say you took CF home on the news, as you said with the potash news, it did gap down, but it went positive. Okay, so if you took the right play home, you had a way out. Besides, maybe catching the move the day before. So with that said, I do think a lot of traders, the same day said, what could I also buy with that? And they didn't do their homework, because there's a big difference between nitrates and the phosphate producers, whatever. And they went home long, Mosaic and potash and this and that. And then once we get into those charts, you'll see that if they got caught, there was no way out unless, you really just went in all in on those lows for a move to the close. So with that said, if there's opportunity, if you're not caught in the mess, but just when that type of situation happens, you're always better off going with where the actual catalyst is, the leadership stock that's leading the way. You can make some money in the second and third tier names, but you're better off always going with where the action is.
Like you said, CF produces fertilizer that's more nitrogen based, so it was not as exposed to this news. But a stock like Potash Corp of Saskatchewan, the biggest potash producer in Canada, huge move lower, was down as much as 25% or so pre-market, was able to bounce a little bit into the open, and then it was able to rally a little bit back into the session. Is this something that you still might look for opportunities to buy this dip, or is this something that you might look to fade, or is this something that's just on your radar, something to watch maybe for short-term cash flow type opportunities?
I think it's all short-term, level versus level. Like yesterday, I was like, guys, if you're going to play these names level versus level, they're down, some are down 20%, 25%, 15%. You never know where they're going to go. So, a lot of these things in the first 30 minutes did stabilize and gave you a low to trade against, and then a high, to get into the gap. And if you look at POT, you will see, here's when it put its high in back in 2011. And since then, it's been in a lower channel, not doing anything below all moving averages, probably for a reason, while other indices and stocks have been making 52-week highs and 2013 highs. So with that said, here's your gap down. So if you were not in this mess, okay, here your low was 29, and it wound up rallying, a nice percentage to close green. Today, I think that it was downgraded by Citi. So I would say, maybe look to see if it could hold the top third. And if it goes into this gap, look at the size of this gap. Okay, if it goes above this high here, which yesterday's high was 31.89, that would be your tactical long to say, okay, maybe it was, that was it, that's the bottom, because sometimes news like that marks the bottom, especially of a big time downtrend. So it could be a cute trade to fill this gap for tactical traders that are looking for something to do in the last day of July or the first few days of August. So at least now, if you're not caught in this mess, it becomes an opportunity for you.
Mosaic, another stock that it was actually listed in your 2013 thesis as your favorite ag stock, and that's another one that has a lot of exposure to this potash business. And it actually got a little bit more buying interest even than Potash Corp Saskatchewan. And corrections like this, maybe you're even an opportunity to identify which one of these stocks in this sector has the highest demand, and a decent bounce back from Mosaic that could show that it has a little bit of leadership in the group.
Right, and this one came off the lows, and it was a trade. And as far as stocks that we put out ahead of time for the 2013 thesis, lots of people approach it different ways. Some guys will say, okay, we said 7, 8 of these stocks, to hold and put in the drawer, and different sectors, and maybe 6 or 7 of them work and 2 don't, blah blah blah. Some actually wait for the market to confirm it, wait for it to technically act well to show that it's actually coming in with the actual thesis. And the ags, unfortunately, never really came into play this year, and they were always relatively weak. So you've seen guys on the virtual trade floor not really trading these names that much because, again, there's been no continuity there. But anyway, with Mosaic, if you weren't involved, okay, on this break, this looks like potash where it opened lower, stabilized, closed somewhat strong. So with that said, I think it's off a little bit today. So same type of thing. Maybe with some time it holds the top third of this range, and then you get a cash flow type trade through yesterday's high, and yesterday's high is 44. Maybe you have an inside day or two and then it goes, but something to watch now, considering that these type of crazy plays, like if you look at the volume here, go to basic studies, go to volume, look at the type of volume there, that could be capitulation volume. If it would have closed on the dead lows yesterday, I would have said, give it some time, but because of that volume and it closing the dead highs, I think it's something that could be on your radar for some further action.
You talked about that volume is actually the most volume ever in the history of a day for Mosaic, so obviously a huge day to take notice in that, and something to watch going forward. Agrium, AGU, another stock that had a little less exposure to the potash group, and likewise wasn't quite as weak, but it bounced back fairly well yesterday. Could be another one that traders have on their radar.
Yeah, and this one actually almost filled the gap. So this was, again, you just don't jump into things. This one's more in the CF type family, versus the Mosaic, potash type family. And everyone always puts the ags together, and instead of doing a little bit more homework. So if sometimes you get caught on that, it's a little bit your fault. But this one also, not as weak as some of the others. It closed sort of green. And this one, I don't think there's going to be that much opportunity, but over time, if it were able to continue to be in this range at some point, if it wants to break back above this high here, you get some momentum, but this is going to need some work to be done because there's still a lot of damage here.
All right, well, that'll do it for the sector spotlight. We'll go to a quick commercial break, and then we'll come back with high beta tech in the trenches.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our 2 very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF. I'm Mark Sperling, All
right, we're back here for In the Trenches, where we're going to go over high beta tech. Obviously, a common refrain from us, high beta tech. There's been a lot of action there. We talked about the tight range in the S&P, lethargic action. There hasn't been any shortage of action in high beta tech land. First of all, you have to start with Apple as it's come back into play a little bit. Apple, solid earnings report. You got to understand context in these earnings reports, and Apple was not expected to really come out with anything major, blockbuster in this earnings report because they have no new products in the pipeline that look imminent. But still, they were able to beat expectations, and that has provided a little bit of boost to the stock.
Right. If you go from 700 down to the low 400s, there's really not that much, expected or priced in. So you look here at the chart, it's actually nice to see that, you know, it's been tradable again, and we've been getting these tradable spurts. If you remember when it broke this, you know, upper area back, what is this, in September, October, you know, that's when the stock really changed. That's when people started talking about the slow growth, the lack of innovation, maybe even the slow demand in the iPhone 5, whatever. It broke 650, that was one way out for macro investors. Here, another one. When it broke 600, a longer term trend, that was another spot. Okay, and from there, it's just been, you know, a ride down with many different trades along the way. So down here, you know, we started to take a look at it, you know, into the earnings, this little, you know, head and shoulders type pattern or rounding bottom type pattern, whatever you want to call it. You know, so there's been a new accumulation down here between, you know, the 380 and the 440 area. So with that said, you know, into earnings, we talked about a potential strategy, and one of it being maybe being some calls, which worked okay, but really it was, you know, how do we get a nice tactical 3-day trade? So the ingredients for that was, one, a gap up. Here was the gap up after earnings, so, you know, pretty sizable, not so crazy, but enough to, you know, put this back on the map. And then you had your 3-day digestion. So for those of you who are on the virtual trading floor, which is a paid-for service that we have, so you can see our positions go off and on, this was one of your entries. This is that red dog reversal combined with the gap hold. So that would have been 435.81. I do believe, I'm not sure what price, but somewhere around 438, you saw it come back on for me. Sperling's still in it, he's been holding it. So that's your day one. Then, you know, we had it off the charts, we had it on the price point sheet. On the price point sheet, I think we spoke about either 441 or 445 as another entry. And then here's your 3-day move. That is a nice 3-day tactical trade that we look for. Great setups that we teach in a lot of our education courses, and it happened. So now the question is, you know, kind of go sideways again, you know, and flag again, just like you saw, for a potential move up to the 200-day, which is still above it, you know, or is the same old apple that fails after a while? I kind of think it changed, you know, and it could go higher, but at this point, you know, do I think it's going to go back to where it came from in, you know, at 600-700? You know, at this point, you don't really need to know. Right now, you want to measure the commitment, and right now, it's acting a little bit better since earnings.
All right, and then Netflix has obviously seen a very impressive resurgence, and a lot of that has been due to some really blockbuster earnings reports over the last few quarters. This most recent earnings report was a little bit more lackluster and wasn't able to trigger another one of those big gap ups in Netflix, and now it's sort of teetering. It's been prone to trade within a range after earnings and not provide much follow-through, but it looks right now like it's a little bit mixed, and you could make arguments that it could break higher or break lower out of this tight little range.
Yeah, I think some of the compelling type of setups like Mark had with his play of the week before earnings, that was something tight and ready to go. Now, after earnings, after the sizable move that this stock has seen this year, I don't think you should have big size either way. You know, all in all, though, it's still hanging in there. It's still in the game. Look at the chart here. You know, real quickly, you want to, you know, draw, you know, this trend. You know, it's still holding in, okay, which is really nice. You did have a few better gaps. Obviously, this was one gap up after earnings, another gap up. This is when Sperling came out with his play of the week. Nice job. You know, we typically don't take stocks into earnings, so if you didn't, you know, and you're a trader and you're flat, watch this range. Okay, if it were to break and close below 240-ish, perhaps you see a move to, you know, the 50-day, which comes in about $10 lower, or if it stays sideways and wants to continue this trend from right here, you know, maybe a close above this, you know, 250.67 gets it back in the motion. So right now it's really just, you know, tit for tat. But at some point, you know, Netflix doesn't like to stay tight forever; it likes to expand. But at this point, you know, it's hard to pick a direction.
And Amazon came out with an earnings report that on the surface looked like it was a little bit mediocre. They swung to a loss when they were expected to make money, but then again, they got a pass from Wall Street, ignited 2 all-time highs, but then after that, it's been a little bit lethargic, bleeding lower. What do you see in Amazon right now?
I just think it, you know, it's like the juice is loose, the earnings are out, so shorts aren't scared about earnings, and longs don't need anything. You know, they don't have to like be so propelled to get in there. And again, with Amazon, you like tight patterns too. You know, and this one gave you trades before earnings, which is great. So you didn't have to be in there for the actual earnings risk. First trade we talked about was when it came above 272, when it showed a lot of relative strength during the May decline. Next one was at 2013 highs at 285, it broke above. And then on earnings day, it was a little bit crazy as it was lower, and then it blasted off through the highs, and then it's just been bleeding the last 2 days. I would say at this point, it's probably going to be very, very choppy. Maybe you want to do some, you know, little micro trades in there, but it's probably going to take time to channel, kind of like what it did here for a while with lots of little active trades, but nothing so substantial as it absorbs what's been a huge move. Look at Amazon. If you're a stock picker and you've been holding this for multi-years, you know what? You've built some wealth for yourself.
I think Google has been resting for the past couple weeks. It was leading the market tremendously prior to that, prior to earnings. But like I said, it's been quiet, lethargic. But it did wake up a little bit yesterday, surge almost 1%. Do you think this is something that could come back into play and perhaps get back to highs to lead the market?
I think people on the virtual trade floor were talking about putting a feeler back on in Google. You know, their earnings were good, but it wasn't enough to propel it to 1,000. But ultimately, I think people like this one. The institutions are still behind it. It's a little over-owned. So if it's over-owned and it's very capital intensive because of the price, when it's not in play and there's no catalyst, it's just going to flounder around. You know, but then they'll try and protect it where they have to. You look at the chart here of Google. Lots of nice trades along the way. This was the descending channel, broke to the upside. Here was another descending channel. When it's out of play, this is what it does. It just meanders lower and then boom, starts to wake up. So here you are, coming into support. It did hold this 875. It did wake up yesterday. You want to take a closer look here. I would say in order for this to, maybe people think they're missing out, it's going to have to get above this area, which is about 894 to 897 to then head back to the upper end of this range. But right now, still holding where it has to. It's still in this trend, but again, there's a lot of things going on out there. So people are trying to, I guess, keep a little risk off, especially on these capital intensive stocks.
And then LinkedIn reports earnings after the close tomorrow, but has been another stock that's been extremely strong, extremely resilient. Its most recent earnings report prior to this one was actually a little bit mediocre, and I even expected it potentially to break down, but it reversed quickly off the bottom end of that upper range and made new highs. And the enthusiasm over the Facebook earnings, I think, perhaps are spilling over a little bit into the expectations for the LinkedIn earnings as social media looks like it's grabbing hold a little bit. Obviously, you talked about you don't like to take equity into earnings. Is this something that you might look to play up into the close tomorrow?
This one, I like the fact that it pulled in a little bit. So maybe, you could do an option play, so it's something I might do. This one, we talk about ingredients, John. Like, I think, what was it last year? Like, okay, what type of stocks can be something to throw in the drawer and hold? Stocks that have been IPOs, that have tremendous opportunity in growth arenas, have tight floats, and were successful IPOs. And we talked about Dunkin' Donuts. It was Dunkin' Donuts, Coors, and this one. And if you look at the chart of this one, just so you see this type of chart, so you know what it looks like, so you don't miss it the next time, this was your cup and handle type pattern. And it took a few quarters before institutions got very comfortable as they beat a few different times before it finally had a massive breakout. So you talk about tactical trades and you talk about things you could throw in the drawer and now look at for a few years and build some wealth, and this has been one of them. You want to look short term now, where we are, because that's what we do. We're more intermediate, we're more active. Okay, last quarter, it gave you a nice move into earnings and closing the high. So there was no reason to take it there. From there, became just like a shorter term, tactical, cash flow type of scenario where you could have made money short. And then here's when it broke this little downtrend in order to continue higher. So I think we'll see where we are going into earnings. But overall, the high here now for the pivot to trade after hours would be 209 if you trade stocks after hours. At this point, I don't, it's not really a compelling A setup. If it were to come in a little bit more and you wanted to take, 210 calls and your risk is premium paid, I think I'd rather you go with that than, especially if you're short term, if you're saying I love LinkedIn no matter what for the next 5 years, then just sit tight. And I do think with, in that type of time frame, you could take some of that earnings risk.
You talked about the LinkedIn IPO, and I remember the day that LinkedIn IPO'd and it spiked up to $120 a share, as you saw a little glimpse of that on the chart, and everyone was saying, oh, 120 is going to be the top for this stock after it closed off highs. It was an amazing, amazing move. It's just interesting to see how far LinkedIn has come and how far social media has come, especially after this Facebook announcement.
Well, so you know what, on that subject, I just want to talk about Facebook because I know a few different times, I've talked about this, so similar cup and handle pattern that took more time, and sometimes it failed. You know what? At first, remember this one, it looked like a cup and handle pattern a little bit right here, okay, but needed more time. And if you were trading it for that, remember you got stopped out of 31, and then over time, depending if that's what you do and accumulate, you look at this pattern build. Let me get it in here so everyone could see it. Okay, come on. Let's see. Let's go to we'll go to the weekly. So it's boom. Okay, so with this pattern, okay, it takes time. And this is not, actually, you look at it now, it's really not that sloppy, right?
It's just a really long handle. It was like a stovetop pot or something instead of a cup.
Yeah, you had to like give it a little distance. It was like you roasting marshmallows. Yeah. So here's that descending channel. Okay, so depending on your time frame, some people accumulate it the whole way down if they have that risk, which I don't think you have to do at times. And then, some traders after hours, when it traded above 29, they could have bought a little bit, or when they traded above 32, you also could have taken options. If you were on the VTF, you saw that I had calls on a call spread. Sperling had calls. It wound up being a little bit of a lottery ticket. And then if you did not want to own it into that, and you wanted to wait till it cleared this. Okay, you could have gone to your daily chart and used the same type of tactic we used for Apple, okay, where you had, here's your earnings gap, so look at the size of this gap, this is the point to trade against, and then once it went in motion for the active trader that doesn't trade earnings, that doesn't even do options, your buy price was when it cleared 34.88, and then another 10% tacked on. So lots of different ways to make money within this. You just need to know what tactics are for you.
And psychologically, I think people had a tough time chasing Facebook after that big gap. But like you said, if you have tactics to approach it, you have a big disruptive gap like that, there can be some opportunity there.
Yes.
All right, so Tesla, another one we could talk about that has been highly on the radar of short-term traders, extremely high beta. Yesterday, it had a little bit of an outside reversal. Looked like it was going to have an outside engulfing bar after Citron came out with a negative piece on it. Citron is a well-known blog that comes out with a lot of short theses about various stocks, oftentimes targeting smaller Chinese-type stocks that they're a little bit skeptical about. But it was surprising to see them come after Tesla. But it was able to do some damage to Tesla. I tweeted something. I said, for Citron to come out with a negative piece on Tesla, it's like shooting a shotgun into a rhino. It's only going to make it more mad and might trigger a squeeze. But it actually did see some downside. So I guess maybe that bounce could happen sometime. It did bounce into the close a little bit.
Right, and it's up a little bit today. And the same thing, when it was up $1, I tweeted also, I'm like, Citron negative on Tesla, take a little care depending on your time frame, and I'm sure there'll be some kind of dip to buy because, again, they're always negative on everything. I don't think I've ever seen a positive report from them. No. So whatever.
That's what they do.
Anyway, with that said, you could have combined if you acted quick, and that shows you how you have to have, instincts as a trader. If you were long Tesla, because there's been many reasons to be long it, and you want it to be cute, it was up $1. You knew the short-term red dog reversal, which you take a little caution, which is sometimes just short-term, was right here. So you look at the chart. This most recent pattern was it opened up, and also it came after a 3-day move. This was day 4, so it was really coming from, just say the 120s. So up here through highs, why wouldn't it just have a minor effect? And at this point, this is a minor effect. Because look what it did. It held the 8-day. It's still going sideways. Maybe has an inside day or so, and then it goes again. This was the Goldman Sachs article. That's a major effect. Okay, this was nothing. Okay, in the scheme of things. And if you look at these tactics, lots of 5, 15, 30-minute chart tactics as well as daily chart tactics, which the last one was right here. A nice red dog reversal, 107.30, before tightening right here for another move into the high. So now let it go sideways a little bit, maybe make your time frames a little shorter, and then over time maybe we get another move to that 140, 160 price target that I put on with the street, which I think you've been talking about this stock since here. So you were on it well before some others.
These stocks with these huge short floats have enormous opportunity, and this one's gone further, faster. When it initially made that move up to $60, $70, I said, man, what a huge move. Maybe a little bit tough to chase, and then next thing we know, it's well over $100. But Green Mountain Coffee is one that was highlighted as Mark Sperling's trade idea of the week, which is something that's educational as well as sharing a trade idea. And Green Mountain is eerily reminiscent of Netflix in my mind, is that both stocks were momentum darlings in the market from 2009 to 2011. They've both been heavily shorted along the way, had big pull-ins, and then have been resurgent if they've proven they have a little bit of staying power. And both sort of have upper-level bases that they've built, high short interest, like I said, and looking for a similar type of move into GMCR earnings like you saw in the Netflix earnings like we talked about earlier.
So I'm going to keep it quick. Yes, they triggered above
Took
76.
all the words out of your mouth there.
Above 76 was tier 1. Today, if it gets above 77, maybe it gets momentum. Take a quick look at the chart, very quick. Here's where it's starting to get above. If it can start to clear it with some authority, maybe you get a move back to highs. So put this on your radar. And
then finally, LVS is one that reclaimed its 50-day moving average on a nice move up that could be back on the radar of traders a little bit.
Yeah, the casinos have been somewhat lethargic. I think a lot to do with China. With Macau slowdown and their economy slowing down, so it hasn't been the place to be. But if you look at the chart here, this is where it held. Its earnings are out of the way. Hopefully we get like an inside day or so, and then I do think that you can get a move through 56.43 for a move back to highs. Just want to touch on MGM, which I've talked about keeping in the draw What I mean by in the drawer is I mean that I think there's a lot of potential. You might not want to trade it because it doesn't trade great sometimes, and you just could get higher prices. So I've talked about 18 to 22 for 2014. I still think that could happen. Right now it's still acting well for traders here and there that want to trade it. Next level would be to be getting through this 1652. This has actually been trading really well, for a potential move to highs, but you still have to deal with earnings and the earnings risk, which is sometimes a little tricky for traders.
You zoom out on MGM, and that's a huge level that it's looking to break there around the $1650 area. So.
Oh, yeah, go to the weekly. Look where this thing was,
chart.
and look where it is. Some people are like, oh my goodness, I started playing this at $8. I can't play it now. You know what? Why not? Look at the size of this channel here. It's just starting to go. It kind of looks a little bit like the Yahoo chart that we put up when we loved it, last year at 1660. That was this channel down here, and now look at that move. So anyway, we like to find stocks that have been channeling that are now under accumulation, and when they break out and they have some name recognition and their comeback stories, sometimes you keep them in the drawer just so you hold it and don't trim and trail your way out of it, like I've done with many of my good positions where I'm all of a sudden, oh my God, I don't have this anymore, besides just trades.
All right, well, that'll do it for today's morning call. We obviously have the GDP announcement that's going to come just a couple minutes after we step out of here. It might have already happened depending on how long-winded we were.
We're always
we like to babble. We both have a lot to say. And then we have obviously the Fed announcement at 2:15, which could move gold, could move bonds, could move the market out of this upper range a little bit, but not a ton is expected from that, but could wake things up a little bit. This has been your Editor-in-Chief, John Darsie, here for the morning call. Have a good day.